Hello everyone and welcome to your Glassnode video report for week 41, 2022. So Bitcoin has gone uncharacteristically quiet of late. We've seen the market really just consolidating around this $19,000 level. We looked at last week the cost of production, and we've seen an upward difficulty adjustment that's essentially brought that cost of production right up to our current price level, about 19,300. So it's very uncommon for Bitcoin to sit in a very quiet and non-volatile period, especially against the backdrop of currencies, forex markets, and bonds really starting to blow up all over the place. We're seeing challenges over in the UK. We're seeing challenges in Europe. We're seeing the Japanese central bank defending their peg. So there's a lot of volatility out there in the traditional finance world. And meanwhile, Bitcoin is essentially trading sideways. It's become a stablecoin here at $19,000. So usually we don't sit in these periods for very long, and we're calling this a bit of a calm before the storm because usually this precedes some kind of volatility. The challenge is trying to work out which way is it likely to go. So what we're going to focus on today is a few different angles. The first thing we're going to start with is the accumulation trend score to really assess the market structure of our current situation relative to the previous time that we saw this, which was essentially right before a 50% sell-off in November 2018, but also just before the rally that we saw back in April 2019. So there's two different cases, and we're going to try and understand the market structure, how it looks similar, how it's different, and with a particular focus on whale entities who tend to be on the right side of the equation for the most part. Now, we're also going to do an interesting study looking at the supply profitability and adjusting for lost coins. Over time, we see more and more of the supply, and obviously this happens more back in the early days, but more supply gets lost, and thus we need to do some slight corrections to some metrics to just try and account for this. And the last thing we're going to look at is a crossover between long and short-term holder realized price, what that means, and again, how it has similarities to previous cycle market structure. So as always, please do give us a share and a subscribe, and please do stick around for the section where we look at a couple of new dashboards we've just launched. We're looking at things like Bitcoin capitulation risk, an introduction to lifespan and realized value. I'll give you a very quick overview just so you can get a flavor of what we're rolling out on the Glassnode platform. So let's get started. So as I mentioned, we're going to start this session by a deep dive into the accumulation trend score. Now, this is a really, really powerful metric, and what it's really doing is looking at on net across the entire market, both whales and when you've got a large portion of the market adding to their on-chain balance, this will turn purple. Now, when does this happen? We typically see this at the top when you've got lots and lots of people excited by the news, buying the actual top. We also see it at capitulation lows and during bullish rallies. So these are all kind of highly volatile events. Here's March 2020. Even though price trades down, what this is telling you is that there is a change in investor behavior. We are seeing investors behaving in a particular way. You can see how distinct the bear market of 2018, really yellow. This is net distribution, coins flowing into exchanges, investors getting out of their current positions. We saw it here again during the market top. And then we can see it during sporadic periods all the way through. So what we're looking for here, and the power of this tool is looking for changes in behavior. You're looking for when something has changed that's quite distinctly different. Now, I mentioned at the start of this session that this previous quiet period, for those who were there, Bitcoin went completely silent, traded between $6,000 for a number of months before caving in by 50% during the final capitulation low back here in 2018. Now, we then entered a very similar, well, it was a bottom. You can't tell it's the bottom until after the fact, but this was the bottom formation, a large behavioral shift, and then we entered an equilibrium period before another very quiet period for about a month before we broke up to 14K. So both of these periods are quite similar to our current market structure. We've got our large capitulation event that took us down below that 20,000 level. And as you can see, there was a huge amount of balance change in a positive direction during that time. We then have a period where it's this kind of equilibrium, a little bit of distribution, a little bit of accumulation, but certainly not bright yellow that we saw during previous periods. But again, very, very similar to this point here. But you can see that there are similarities in market structure. And this is similar across a number of Bitcoin metrics. There are a lot of things that resemble previous bear market bottoms. That doesn't mean to say that this is the bottom, but it's certainly looking like across many metrics that we're essentially dotting the I's and crossing the T's. And if we looked back in a year's time and this did turn out to be the bottom, it would essentially be a textbook version of it. It looks like all previous bottoms that we've seen, but again, the market works in strange ways. And at the same time, we have to keep into account that we have a very, very challenging macro environment. So things could be different, but within the context of Bitcoin looking at itself in a vacuum, there's a lot of similarities of our current market structure to what we saw back here in 2018, both before the sell-off, but also before the rally. So there's similarities on both fronts. So the beauty of this is we can actually break down that accumulation trend score by looking at different cohorts, different wallet cohorts. Now, this color bar up the top here, red is essentially distribution, blue is accumulation, and yellows is essentially an equilibrium or no change to their on-chain balance. The bars at the top are 10,000, 1,000 to 10,000, 100 to 1,000 BTC entities. These are large entities, and what we're looking at here is that 2018 to 2019 period. Now, what we've highlighted is note that there was a bear market rally. We essentially came off the lows, very, very similar to what we saw recently up to 24K. This was effectively dashed, but it then moved back into this uptrend. And during that period of time, we saw our 10,000 and our 1,000 BTC entities distributing into that market rally. So they were essentially putting in a top and then they returned to an equilibrium. Also note that retail investors with less than 1 BTC simply don't care. They are buying the whole way through. High conviction, good for them. Now, if we now look at our current market structure, remember price was down at 6,000, 3,000 back then. So we are currently sitting up here, not quite 10x, but not far from 10x above at 20,000, 19,000. So you can see that the 10,000 whales are essentially 1,000 whales. We've essentially seen a 10x change in the overall balance. And you can see that same bear market rally, which was sold into by larger cohort entities. Now, more recently, the 1,000 to 10,000 BTC have been starting to accumulate. There was definitely some distribution of these very large 10,000 entities, but that is softening back into equilibrium. And we are somewhat into the equilibrium phase. Interestingly, retail has softened out of late. So it really does show just the level of uncertainty that's going on. But certainly there is some market structure similarity in that whales have essentially put in some kind of a top, but as we trade lower, their behavior shifts again. So they're in this bit of an equilibrium type phase. It's certainly interesting to observe across many levels. So having now established that whales have some kind of semblance of reality here, and they're putting in tops when we get the rallies higher, but also shifting their patterns as price goes lower, what really matters is where is their cost basis? Where's a point where whales may be willing to step in and defend? So considering whales typically have much longer term time horizons, what we've calculated is the realized price, or in other words, the average cost basis of whales, and we're only looking at coins they are pulling in and out of exchanges. So look at the coins coming in and out of exchanges, going to 1,000 BTC plus entities over the course of 2017 onwards. So we're essentially looking at the last 5 years worth of data and seeing what was their average accumulation price. And you can see that both inflows and outflows basically overlie each other. There's always coins going in and out. There's a bit of a divergence, but for the most part, they are the same. And it's currently sitting down here at 15,800 or 15,700. So that type of realm is essentially where the cost basis of these whales, these 1,000 plus BTC entities, they have a cost basis down there about 15,800. Which is quite interesting. And you can see that we are essentially hovering just above it. So in terms of a level that may come in as some kind of psychological significance for market structure, if we were to trade lower, that would be a key level to watch, because if it does provide support, you're then seeing those whales defending their cost basis. Conversely, if we break down below convincingly, that could very well be a capitulation level. We could actually see even more sell pressure once that level is breached. Again, we don't know what the future holds. What we're trying to do is assess key levels to be paying attention to, and then you can build up a framework as to what happens should we get there, get below it, get above it. Trying to build up a framework of where that risk potential is. So now that we've kind of got a bit of an established view on what the whales are doing, I want to look at supply profitability. Now, this is a really, really important part of on-chain analytics. There's really two things, and we'll talk about this in the dashboards in a second. But profit and loss, the ability to actually see where the coin supply was last moved and thus calculate a profit and a loss, is one of the really important pillars of on-chain analytics and what makes it really quite different to traditional finance analysis. The other one is lifespan, looking at how old the coins are, which we'll touch on more with the long and short-term holders. So we're going to start with the percent of supply and profit. Now, on a very big picture, this looks like a big picture oscillator, right? During the bottom of bears, the maximum number of coins are not in profit, they're in loss. And likewise, when we're at all-time highs, by definition, everyone's in profit, so 100% supply in profit. So besides this thing behaving as a long-term macro oscillator, big sharp moves also indicate concentrations of cost basis. We've talked about this over recent weeks, but what I want to look at here is the absolute level. And you can see that we're currently sitting down here about 50 to 52% of the supply is in profit, which means that 48 or thereabouts percent is in loss. Now, you can see that we've been much worse off. Previous bears, we've seen 40 to 42% is typically where we bottom out. But now also think about all those coins that have been lost over the years. Satoshi's coins, assuming we don't go to zero, will always be in profit. Early miners who got in at $10 will probably always be in profit. So we can kind of see that as these coins get lost, they will contribute to the percent supply and profit. They'll essentially always be in profit. And you can see that we've got this long-term gradual uptrend. So what we've done in this particular study is tried to adjust for, in purple down here, these are coins that are older than 7 years. Now, it's very challenging to work out some coins we know are lost, some coins we have to assume. So here we're just doing a very, very simple adjustment, just something to kind of get a bit of a gauge and see what does the impact of these lost coins have. So what we're going to do is exclude the impact of these 7-year-old plus coins. We're only looking at those that are more or less economically active in the current economy. So the yellow curve here is the one that we just looked at, and the blue curve is now subtracting out those coins which we are presuming to be lost. Now, what's quite interesting here, let's just quickly jump up. Note that we are currently, if we look at this view, remember that the lower this value goes, the more pain is in the market. And what we're looking for is that point where sellers are exhausted. There's so much financial pain in the system that essentially there's no one left to sell. Now you can see that March 2020 is quite substantially below that. It's about 45%, and here we are at 50%. So 5% of the supply is still in profit relative to March 2020. If we go back down to our adjusted level, we are now at the bottom of where March 2020 was, and we are pretty much at the lows. Not quite as bad, but we are very, very close to the same level we were in 2018. So once we adjust for these lost coins, we can actually see that the economically active coins, those that are really moving around the system, they've been active in the last 7 years. If we only account for those, we're actually in a financially pretty severe position. So it kind of gives us a bit more of a grounding that, hey, this bear market has actually been pretty savage. It's essentially offset the tremendous profits held in the lost Satoshi coins and the early miners. Millions of coins haven't moved in a very, very long time. So what we're doing by correcting for this is actually looking at what is the financial pain amidst the current market participants. Now, if we look at this on the relative unrealized profit, what this is doing is looking at how much profit, almost like a dollar value proportion of the market cap is left in the system. We can see a similar thing to our percent supply and profit. We're kind of just above our 2018 level. We're above March 2020. So based on this cursory review, you would say, well, perhaps there's more pain that needs to happen before we reach that seller exhaustion level. But then if we bring it to our net unrealized profit and loss, this is looking at that same metric, except looking at it on a per market cap basis. We have the same impact. We're kind of at the same level of financial pain as March 2020, but 2018 was substantially worse. We got much, much lower on this particular metric. And if you were to look at this at face value, you would say, well, we've probably got another capitulation to come. Remember, that may still happen, but that may not be the correct outcome to take from this metric. Once we adjust for those lost coins, the absolute amount of unrealized loss, basically how much loss is held in the system. This red and green curve is looking at the standard NUPL metric. What we're looking at with the blue curve, which by the way is much below March 2020 and is pretty much as bad as it was, except for the very, very tippity bottom back here in 2018, we have as much financial pain in the system as we've had in any of our previous significant sell-offs. So by actually adjusting for those lost coins, again, they may not be lost. Some of them may come back in. but also they've been dormant for a very long time. The probability of them deciding to sell because we get a candle below 18,000 is pretty slim. So thus, we're really trying to capture what is the real economic weight within the system. And what this is telling us is that we are actually worse off than we were at March 2020 and as bad as some of the worst points in 2018. So there's good odds, what I was saying earlier, that we are essentially dotting the I's and crossing the T's on what could become a textbook Bitcoin bottom. Now, again, we have to remain extremely vigilant. With the world as it currently is, anything can and will happen. So we just have to keep all of these risk levels in play. And that's why we looked at the beginning at what the whales were doing, trying to establish where is a cost basis, where's a point of support and or pain for that cohort, because then we can try and assess essentially what the others in the market are doing and using on-chain data to assess that. So just before I tick on, I just want to give you a very, very quick overview of some of the really cool dashboards we've recently rolled out. This is something that we're rolling out in greater detail over at Glassnode. Something we find that dashboards are a great way to get a packet of information, but also find out, what's going on in the space and trying to curate the right metrics for solving particular problems. So there's 4 dashboards I want to cover that we've rolled out, and we're rolling out new ones each week. The first one is looking at Bitcoin supply curve. So this is really just a very, very high level understanding the Bitcoin issuance rate, understanding some of the supply dynamics metrics, just understanding what it means by coins being a particular age, things you may see shared on Twitter or various places, just to give you a bit more context into what these different supply metrics mean. This metric here is looking at the supply last active that's less than 6 months old. So there's kind of 2 ways that I look at things. Coins that are younger than 6 months are very economically active. They're essentially liquid supply. We expect them to be spent. But over time, particularly late stage bear markets, we see this really start to decline. And this is because those hodlers are taking those coins off the market and they're getting older than 6 months. So obviously if they're younger than, they're not older. And if they're older than, then they're not younger. So you're looking at that kind of binary behavior of coins that are pretty stationary. And as you can see, we are essentially on a percent basis at a very, very low level, almost at all-time lows of coins that are younger than 6 months, which means we're almost at an all-time high of coins that are older than 6 months. And again, this typically happens as you head towards those later stage bear markets. So that's the first metric, looking at supply dynamics on a big picture. We also have a new one looking at miner capitulation risk. And this is essentially a tool that you can use to assess stress in the mining industry. We're currently seeing hash rate pushing to a massive all-time high. Difficulty wound up to a new all-time high this week. And what we can see is that the cost of production line is now converging with our spot price. And this tells us that miners may increasingly be under stress. There's a number of mining capitulation levels trying to ascertain where that cost of production is. And like whales, if we dip below or trade above, that can increase or decrease stress accordingly. We've also got their revenue, so understanding where exactly their revenue falls over recent months. And then a final minor capitulation risk tool, which this thing will flag yellow when we have both their income in stress, signified by the pure multiple, but also the difficulty ribbon compressing, telling you that you do in fact have hash power coming offline. So really a tool to help you sequence out and gauge and assess, do we have stress in the mining industry? And we've also rolled out 2 brand new tutorials. So on the left-hand side here, you'll see we've got a suite of tutorials. These are really geared at helping you level up with your on-chain analytics. And they really do increase from simple. We add more layers of complexity and more skill as you go through the tutorial set. So as I mentioned before, coin lifespan is one of these really unique things. This is looking at how old coins are. We see older coins getting spent during bull markets. This is the smart money getting out. And we see less during bear markets. The smart money is accumulating. And you can see that we get these oscillation behaviors. And right now we have the smallest amount of lifespan being spent essentially of all time. So we are seeing the hodlers be hodling, and for the most part, coins are coming out of circulation into investor wallets. And whilst this doesn't mean that price goes up tomorrow, what it does show you is the conviction of those long-term Bitcoin holders. They're just simply not spending at this time. So we can explore things like average coin age. We can explore liveliness, which is one of my personal favorite metrics. Strongly recommend understanding what's going on with liveliness. It's a very, very intriguing metric, and it's very information dense. And the last one that we have here is an introduction to realized and unrealized value. You will see me talk about profitability and coins in profit all the time. This is a really powerful idea of measuring when a coin moved, what was the price, and when it's spent, how much is it realizing or how much does the coin hold in profit and loss. So some really, really powerful tools. They have been designed by my team to really give you an introduction, help you level up your on-chain skills and essentially get the most out of the Glassnode platform. So do feel free you can always reach me, whether it's on Twitter, whether it's via email or via our comments in YouTube. I read all of them. So if you do have any questions or comments, please feel free to drop them there and I'll get back to you as soon as I can. Right, so getting back into the action, we're going to close out with long and short-term holders. Now, I mentioned earlier that we've got that 6-month boundary. Long and short-term holders is a much, much tighter version of that. We're looking at about 155 days. This is where we see statistically, when a coin has been dormant for that 5-month window, it's much less likely to be spent. So that's what we call a long-term holder. And what we're looking at here is the short-term holders in red, long-term holders in blue. The lighter colors are coins held in a loss, and the darker colors are coins held in a profit. So again, we're combining lifespan with profit and loss here. So you can see we're trying to put these puzzle pieces together. Now, what I really want to highlight is note during that bottom of 2018, look how it's almost like a big widening valley. All these coins in loss, pretty much every short-term holder's in loss, which is where we pretty much are at the moment. Pretty much everyone who bought in the last 5 months is underwater, and a huge and increasing portion of long-term holders. During this capitulation, it's just enormous. Enormous portions of the market are currently holding coins underwater. Now, at the same time, note that this blue curve continues to climb. This is showing that even though they're in loss, those coins are held by those longer-term investors, people who are more willing to weather the volatility and essentially deal with, right? They believe in Bitcoin so much that the volatility doesn't scare them. Now, note how much this has widened out. We essentially have the exact same behavior. We've reached this point where a simply enormous amount of the coin supply, almost all short-term holders, and pretty much, we're talking about 50% of this coin supply is held by coins in profit. The rest are not. So it kind of gives you a bit of a scale on just how severe this bear market has been. And as we explored above, in many ways, it's almost as bad as any of the previous bear markets that are of, relatively recent and relevant. When we look at the short-term holder cohort, we can see these points in time when a huge portion of them are underwater. Generally speaking, when you get absolutely everybody underwater, you start getting to the point where it's like, if you haven't sold already, you're either waiting for that final breakdown to capitulate. Really, this is what capitulations are, when people just can't stand the financial pain any further. But also when you get to this point when everyone's underwater, some of you may have even experienced this. You're like, I don't care. I don't care how much in loss I am anymore. So this psychological element of once you've been in loss for so long, people kind of just like, yeah, okay, right, whatever. They become at ease with it. So there's a psychological layer to this. And that gets closer and closer to a bottom the longer that a bear market goes on. And this is why that long-term holder supply tends to swell. If we were to zoom out on our short-term holder supply, it's pretty much at all-time lows. So we are seeing that there's so few of them left because there's long-term holders in the market, they're holding coins underwater, and quite frankly, they just don't care. So, I put myself in this bucket. I'm essentially a long-term holder, and I have coins in both shades of blue. So I've been here for some time. I've got some that are in profit, some that are in a loss, and quite frankly, I simply don't care. So the last two charts we're going to look at, this one here is the long-term holders in loss. So really isolating that long-term holder cohort. And you can see that at the bottom of bear markets, this gets pretty high. You can see this almost climbing mountain as price goes down and down and down. There's both more people in a loss, but also more of them are long-term holders. More of them are hodlers. More of them simply don't care what the price is. Here's March 2020. We can see that same effect. Now, as we mentioned before, we're not quite as severe as previous bear markets, but you can see that the trajectory looks pretty much exactly the same as previous bear markets. So we will see whether that final flush out is what does it and puts the nail in the coffin and kind of closes this thing out. We will see whether those long-term holders really do have sufficient demand to kind of set that floor and put that bottom level in. We're going to find out because time continues to press on, but you can see that we have very many market structure elements that look much the same as 2018. It looks much the same as 2015 and to a much smaller extent, 2012. So a lot of these things look very similar. We're kind of dotting the I's and crossing the T's on a textbook Bitcoin bottom. And to really kind of hammer home and just show you just how similar these things are. This chart here is showing you in the red is the short-term holder realized price. It's the average price at which every coin in the last 5 months has last moved. The blue curve is the long-term holders. Now, during bear markets, these purple zones is when the short-term holder cost basis crosses below the long-term holder cost basis. Now, this will normally stay there for somewhere between 145 or 300 days. We've been here for about 15 or 16 days. So you can see that that's that duration element that we just haven't yet got. But what does this really mean? This means if you had entered the market in the last 5 months, you have a better cost basis than people who've weathered all the volatility of the last 2 years. So all of those long-term holders who've been through the ups, the downs, the sideways, the capitulations, the deleveragings, the pain, the euphoria, all of that chaos. If you had just entered in the last 5 months, you're in a better cost basis than those folks. And generally speaking, when that happens is when short-term holder cost basis descends very, very rapidly in towards the capitulation. Why is that? Because the long-term holders who went through all of that washing machine have finally just gone, that's it, I'm out. Get me out of this thing. I hate Bitcoin. I'm never coming back. That's the capitulation. Those coins get flushed from long-term, short-term, whales, shrimp. Everyone capitulates. Someone has to come in and buy those coins. They're those new short-term holders. Their cost basis is much lower. And then you enter some form of bottom formation period. So we will see, as I mentioned before, this has lasted between 145 and 330 days. And given that we're 15 days into it, we still have a long road ahead if it's going to look like previous bear markets. But it's certainly starting to have a lot of similar market structure. It's now comparable across pretty much everything. So really what we've now got is that risk assessment. Where's the whale cost basis? What are the long and short-term holders doing? How can we really assess the magnitude of this thing? And as I said, the pro tip of this session is go and check out those new dashboards because there's a whole lot of information in there to really help you navigate these particular cycles. So thanks as always for tuning in. I really hope you enjoyed that session. As I said, please do give me any comments or feedback on those dashboards. We continue to roll these out. This is a big project for us, so we're really trying to get a lot of these useful tools, curated metrics, making it really approachable with instructions so people can kind of understand what do these metrics really mean, which are the ones to pay attention to, and when you want to answer a particular problem, you know where to go. So until the next one, I'll see you then. Cheers.